Hello and welcome to the Change in Future sessions with Scottish Widows for Pension Awareness Day. Now we at Channel 4 are delighted to partner with Scottish Widows as they help you plan for your future. And we have lots more to come. We're pleased you could join us for the Scottish Widows Change in Future sessions, and I hope it'll answer any questions that you may have about your financial future. Now, over to the experts.
Hi, and thanks for joining us today on the first of our Changing Future sessions. My name's Pete Glancy. I'm Head of Policy for Pensions Investments at Scottish Widows, and I've got the great pleasure of being joined today by Rob Yullie from the Association of British Insurers, where Rob is Head of Policy for Long-Term Savings. Earlier in the year, we issued a report where we survey a large proportion of the British public, asking them about how they're getting on with their retirement planning, the Scottish Widows Retirement Report. And what we're going to do over the course of this session is we're going to consider some of the key findings and also consider some of the things that we as a country, we as an industry, and you as individuals could do to improve your retirement outcomes. And before we go any further, what I'd like to do is just briefly ask Rob to outline the work that the ABI are doing in this space and any key thoughts which Rob has.
Yeah, thanks very much, Pete, and thank you very much for the invitation to join today. So the ABI works across the industry and with government on changes to policy and regulation to make sure they work effectively for the industry and for their customers.
During the course of this session, please do feel free to ask us questions. We have a panel of experts here waiting to answer those questions. So let's first of all consider the overall state of the nation. We've been running this report for 16 years now, and this year there's some good news. 60% of people, which is a record, have told us that they are preparing adequately for retirement. Some good news also in that this year we've seen a significant increase in the number of younger people saving for retirement, with an 11% increase in 22 to 29-year-olds. But young people still remain amongst the cohorts who are saving the least and provisioning the least for their retirement. Rob, what were your thoughts on the figures this year?
Yeah, the figures show the phenomenal impact that automatic enrolment has had in getting more people saving for a pension. So people who were not saving before that change came in from 2012, lower income people, people who worked for smaller firms, those who didn't stay in jobs for as long, but especially young people. It's made a huge difference to their participation in workplace pensions. So before automatic enrolment, there was about 20% of 22 to 25-year-olds eligible for auto enrolment were saving into a pension, and now it's 88%. But not everyone's eligible, and it certainly doesn't mean that they're saving enough. So there's still more that we need to do.
And this is an unusual year, unusual times. And of course, the impact of coronavirus and the economic fallout from the health crisis has had an impact on people's finances in the short term. But what might those implications be in terms of retirement planning? We know that people have seen their savings diminish, and some people have seen debts increase. And some people have seen wages reduced, perhaps on the furlough scheme, or are not able to earn bonuses or overtime, etc. And because contributions into workplace pensions are based on your earnings during a week or during a month over which the contributions are assessed, automatic enrolment contributions have been reduced for some people. But I think it's fair to say that at this point, pensions aren't one of those areas of financial services that have seen the greatest level of impact. Rob, what are you thinking of the key pensions issues related to COVID?
Yeah, one of the concerns we had when the crisis hit was that more people would access their pensions, and either because it's the only source of funds available or out of panic if the value's fallen. But from our data, the opposite happened. So from early in lockdown, there was actually a big fall in people accessing their pensions, between 30 and 50% less, and also fewer people making queries to their providers. But that might well change as the furlough scheme unwinds, as you've said, because the crisis has really shown that a lot of people are exposed to a hit to their income, not just in terms of pension savings, but having a cash buffer available to rely on.
Yes, I think so. It's going to be a balancing act for people there, as you say, trying to build up that financial resilience in the short term and continuing to try to do the right thing for their long-term financial futures. In the retirement report that we published earlier in the year, we called out a number of cohorts in British society who the pension system isn't serving as fully as it might do. And what we've found through analysis by the Office of National Statistics, the Money and Pension Service and others, is that people who have experienced short-term financial detriment due to the COVID crisis are also those same cohorts who have been traditionally struggling to build up a decent part of retirement savings. So it's a dual crisis for many cohorts of society, and those cohorts include the self-employed, women in terms of the gender pay gap and the gender pensions gap that we've talked about recently, and of course they also include ethnic minorities and people who are renting. A common theme across these cohorts is it tends to be people who are in lower paid jobs and less secure forms of employment. And what we're going to do over the next few slides is consider some of those cohorts in a little bit more detail. So one of the first cohorts that we want to look at in a bit more detail are people who are working in what we would call underserved industries, underserved in terms of building up a retirement pot for later in life. And there's a common set of characteristics here. It tends to be people who are working in industries where the average salary is quite low or where there's a prevalence of part-time jobs or short tenures of employment. If you're in a job that pays less than £10,000 per annum, you will not be automatically enrolled by your employer into a workplace savings scheme. But if you're earning more than just over £6,000 per annum, you're entitled to ask your employer to be auto-enrolled, and they will auto-enroll you, and then they will be required to make a contribution to your retirement pot. If you're one of these people who has multiple jobs, and your total earnings may come to national average earnings or even higher than that, but each of those employments in their own right are only paying you less than £10,000, then it's possible you may not be auto-enrolled into any pension scheme with any employer that you're working for, and therefore you'd be missing out on employer contributions, even though your total earnings are relatively high. And of course, a lot of people in these industries are there for shorter tenures of employment, 6 to 12 months, perhaps 2 years, and therefore they end up building a large number of quite small pots, and those can be difficult to manage, difficult to then make further retirement plans. And Rob, what are your thoughts particularly in relation to those small pots?
Yeah, people do move from job to job increasingly, and since automatic enrolment, more of them will have pension savings. So as they do progress in their careers, move through different sectors, then they might accumulate lots of small pots or other types of savings. And we might see as a result of this current crisis, more people embarking on career changes, location changes, which should be positive for them. That's something we're working on now to help people to keep track of their savings is the idea of pension dashboards, where you can view all of your pensions together online and potentially other savings and investments too. And this has been talked about for many years, but it's being delivered now. It might be a couple of years before you can actually use them, but it will help people who've had multiple jobs keep track of all of their finances.
Another cohort that we're concerned about is, of course, ethnic minorities. Ethnic minorities are overrepresented amongst the country's self-employed workforce. There's 5 million self-employed workers in the UK, and that number has been rising in recent years, and those workers are not covered by auto-enrolment. So there's still a challenge that the government's facing into in terms of helping a very large part of the labour force, prepare more robustly for their later years. Pakistanis and Bangladeshis, we found out through this year's research, are overrepresented amongst the self-employed. 24% of that community are actually self-employed, which compares to just 15% of the national average. So that means that Pakistani and Bangladeshi workers are overrepresented in the part of the workforce which at the moment isn't adequately provisioning for retirement. Rob, any thoughts on some of the stats?
Yeah, we talk about the success of automatic enrolment, but of course it doesn't reach everyone. The self-employed are a good example of that. And people in insecure work, like say through agencies, temporary contracts, 0 hours contracts, are also affected. And the Trades Union Congress has done some research on this and found that compared to an average of 1 in 17 people in insecure work, 1 in 8 black employees were in insecure work. So there's two policy conclusions to draw from that. First, that automatic enrolment should be expanded to make sure that it reaches lower earners in particular, people with multiple jobs, as you've mentioned already. But also, employers should make sure that they pay in where they've got a duty to, and that includes through agencies.
So having considered the challenges facing ethnic minorities, let's now turn to younger savers. As I mentioned a moment ago, we've seen some substantial improvements amongst the level of retirement saving amongst younger workers, those aged between 22 and 29, and Rob explained the significant role that auto-enrolment has played in making those improvements, but things are starting to plateau a little bit in terms of the rate of improvement, and young savers are still amongst the cohorts which are saving and preparing the least for the retirements. And it's quite important that younger people, get money into their pensions early on. A pound that you save into a pension at the age of 22 will have 4 times as much buying power as a pound that you save in at the age of 52. So if you can afford to get some money into your pension when you're younger, it can have a very great impact on the lifestyle that you later enjoy in retirement. There's a number of challenges facing young people, of course. Young people at present aren't auto-enrolled until they're 22, although the government has made a commitment to reduce that age to 18 at some point in the future. And of course, younger people tend to be in the types of employment that we've discussed earlier, lower paid jobs, multiple jobs, and we discussed the issues there in terms of getting people auto-enrolled.
Yeah, it is a major dilemma for young people especially, that trade-off between saving for a home and saving for retirement. We need to look at ways to make that decision easier to make for young people. In terms of auto-enrolment, as well as reducing the starting age for enrolling people into a pension, we'd also like to make sure that every pound earned counts towards your pension, and that more lower earners become eligible, and all of those things would help young people to save more.
So having looked at younger savers, let's now also think about those in rented accommodation. A recent report published by the Pensions Policy Institute highlighted that the average rent around the country was higher than the average cost that people were facing who were paying down their mortgage. And that means that people who are in rented accommodation have less money to spend, but also less money to save. And we found through the retirement report that people in rented accommodation were twice as likely to be facing financial hardship. And not only are they unable to get by in the short term, but they're less likely to be able to put money away for the long term. And we were predicting that the average renter could be up to as much as £8,900 per annum worse off during retirement. And some of that, of course, will be down to the cost of rent through their retirement. Rob, a big issue with renters?
Yes, I think so, both in terms of being able to save for retirement and throughout retirement. One thing we'd like to see explored is how means-tested benefits, especially housing benefit, work in retirement. Because for one thing, it's complex, and how your pension can, how you take your pension can affect your benefits, like pension credit. And for some people who end up claiming benefits, they might look back and question whether it was worth saving as much as they did. And it's worth mentioning social care there as well. So no one wants to end up with social care needs, but many of us do. We need a way to pay for them. And owning property means that you have an asset that you can use, even if you don't have to sell your home while you're alive.
Turning now to the self-employed, and as I mentioned earlier, there's 5 million self-employed workers in the UK at this point in time, and that's a number that's been rising in recent years. 34% of the self-employed told us through our research that they weren't saving sufficiently for retirement, and 64% aren't saving anything at all into a private pension. And as I mentioned before, auto-enrolment is a scheme that really works through payroll. It works for employees of organisations, and the big benefit to employees is that there's someone else putting money into their pension in the form of an employer. And when you're self-employed, there isn't that someone else. And also the tax system is a little bit different for the self-employed, so there aren't the same incentives. I think the other issues we've called out in terms of the impacts of COVID is that 43% of the self-employed have seen their earnings fall during the economic crisis that resulted from COVID, and that compares with only 16% of the workforce more generally. So the self-employed, there isn't a framework at the moment that really works for the self-employed in terms of retirement provision, and the COVID crisis does appear to have impacted that cohort of the population more significantly. Any thoughts in particular there, Rob?
Yeah, it's self-employed have clearly been affected by the crisis, and it might end up having to pay more in national insurance contributions. That hint has certainly been dropped by the government, and it's not the first time, because since 2016, self-employed people have had the same state pension. So there have been calls for them to pay more in. So we would say instead of those additional NI contributions, why not save into a private pension instead, which would give you more flexibility about how or when to retire.
And finally, it's important to consider the gender pensions gap. So let's look at women in particular. Like ethnic minorities and younger workers, women are overrepresented in part-time jobs. 2/3 of part-time jobs are taken up by women, and women are also overrepresented in lower paid jobs. And as we had earlier, those two factors tend to contribute to smaller pension pots and poorer retirement outcomes. But in addition to that, women also take more time out of work on average throughout their careers than men for caring responsibilities. And those responsibilities could include bringing up children or looking after elderly relatives. Rob, any key thoughts on the gender pensions gap?
Yeah, over time, some of those things are likely to change. I know that when I had kids, shared parental leave didn't exist, and now it's becoming more common that men take more time off when their children are born, and employers encourage them to. But it's a very slow process.
Yes, I think that the Money and Pension Service, of course, will help to a great extent here as well. I know that they're putting a lot of thought at the moment into specific initiatives and specific resources that will be available to women in particular, to help them think about the challenges which are specific to women in terms of planning for retirement. So it'll be good to see some of those resources being made available in the not too distant future. So looking ahead, there are some considerable headwinds and some considerable challenges for those of us in the industry, for governments and politicians and think tanks, and also for the public and employers who are balancing the various challenges of helping people be adequately provisioned for retirement. I think there's probably, three big challenges that we need to take head on. One is improving the financial well-being, of the nation as a whole. The second is ironing out some of those inequalities experienced by some of the cohorts that we focused on earlier, and really just also helping people balance, and it's complicated, helping people to balance the financial challenges today, which have been exacerbated for some people by the economic crisis related to COVID, along with the need to make some of those longer term financial provisions. And retirement seems a long way off, and it's how do you get the right balance between the short term and the long term? I mean, what are the top things that you would recommend, Rob, in terms of addressing those challenges?
There are some changes that we can make that people have talked about for some time now, specifically related to pensions, such as expanding automatic enrolment, setting a timetable for future increases in contributions, encouraging the self-employed to save, and looking at the interaction of pensions, renting, means-tested benefits, as well as improving access to advice and guidance.
I think, and you touch on the breadth of some of the interrelated points there, Rob, and one of the things that's been talked about has been a pensions commission, but we see pensions and retirement planning very much as part of a more complicated, holistic financial and household financial planning jigsaw. We would like to see a savings commission to consider some of those broader issues in the round, but pensions and retirement planning being a very, very important ingredient in that mix.
Yeah, it's all about planning for later life and all of the richness that involves.
Well, I hope you found that useful. If you'd like to see more detail from this year's retirement report, you can find the report on the Scottish Widows website. I hope that you're looking forward to and you make the most of the sessions that we have planned throughout this week, the next of which will be making the most of workplace pensions, which will be hosted by my colleague Stuart Hopley. And before I go, I'd really just like to say a special thanks to Rob Yullie from the ABI, who's come along today and shared his industry expertise and also given us a bit of a pointer onto some of the things that we can look forward to coming over the hill from the government. So thank you, Rob.
Thanks, Pete. Thank you very much for having me.
Thank you.